Good afternoon and welcome to the National Press Club. I'm John Aubuchon. I'm senior correspondent for Newsnight Maryland on Maryland Public Television and vice president of the National Press Club. I'd like to welcome club members and their guests in the audience today, as well as those of you watching on C-SPAN or listening to this program on National Public Radio. The video archive of today's luncheon is provided by Connect Live and is available through the National Press Club website at npc.press.org. National Press Club luncheons are also carried live by many sites on the World Wide Web. Press Club members may also access transcripts of our luncheons at our website. Non-members may purchase transcripts, audio, and videotapes by calling 1-888-343-1940. Before introducing our head table, I would like to remind our members of future speakers. Tomorrow, March 22nd, veteran journalist Bill Moyers will join us. His topic, what I would have told Stephanopoulos if only he had asked. On Thursday, March 29th, former Senator Sam Nunn will speak on new challenges to U.S. national security. On Tuesday, April 3rd, Ted Forstmann, senior partner, Forstmann & Little, and chairman of and CEO, Parents in Charge, will be our guest. If you have questions for our speaker, please write them on the cards provided at your table and pass them up to me. I'll try to ask as many as time permits. I'd like now to introduce our head table guests and ask them to stand briefly when their names are called. Please hold your applause until all head table guests are introduced. From my left, your right, first, Patrice Hill, Washington Times. Ken Moritsugu, Knight Ridder. Finlay Lewis of Copley Newspapers. Siobhan Hughes, Bloomberg Financial News. Owen Ullman, Washington editor of USA Today and editor of the International Economy. Andrew Bogle, son of the Speaker. David Hess, former National Press Club president and co-chairman of the Speakers Committee. Don Kopecki of Dow Jones. Mike McNamee of Business Week. Michelle Singletary of the Washington Post. Robert McMillan, Washington bureau chief of newsbites.com. And Fred Fraley, Kiplinger's Personal Finance magazine. John C. Bogle Sr., Jack Bogle, is one of the modern mutual fund industry's founding fathers and one of its harshest critics. Fortune magazine picked him as one of 4 Wall Street giants of the 20th century, and Barron's put him on its all-century team, and yet by his own admission, Mr. Bogle is never going to win a popularity contest among his Wall Street peers. John Bogle has been helping other people make money on the market since 1951. Fresh out of Princeton, armed with his senior thesis on mutual funds, then an obscure financial instrument, somewhat, he joined Wellington Management, and 16 years later, he was running the place. In 1974, he founded the Vanguard Group, which included Wellington. In a blatant display of age discrimination, Mr. Bogle finally retired as senior chairman of Vanguard in 1999 at the young age of 70 years. And since then, he has continued to launch rockets at the practices of contemporary fund managers. Bogle is the average investor's champion. He invented the pro-consumer practice of no-load funds that gave investors a fair shake on their money. He pushed an idea that at the time was heresy, the market-indexed fund that pooled investors' money and carefully selected groups of stocks to reduce risk. And all the while, he insisted, even demanded, that his managers and publicists be open and candid with investors about the risks of investing. What a concept. His critics came to refer to him sarcastically as St. Jack. Bogle himself saw that as proof that he was doing what was best for people who put faith in his company. He is still at it. Today, his targets are high management fees, high expenses, high portfolio turnover, and a focus on marketing rather than investing. When Bogle started Vanguard in 1974, the total assets of the then new venture were roughly $1.5 billion. The Wellington Fund itself, still in the Vanguard family, accounted for $900 million. Well, today, Vanguard commands 109 domestic funds and 33 abroad, with $580 billion of its shareholders' money under its management. The Wellington Fund alone is worth $23.4 billion. And its Bogle-invented 500 index fund manages $90.5 billion. So his do-good approach obviously had some merit. We at the National Press Club attribute Mr. Bogle's success to the fact that he is a former reporter. He was a stringer for the Philadelphia Bulletin while in college, and a Gale Group biography tells this story about his newspapering experience. Early one morning, the police told Bogle about a house fire, and exhausted from a night of reporting and chasing sources around the city on the trolley, Bogle decided to call the story into the paper without going to the scene. Quizzed about details of the fire and the color of the house by the desk editor, Bogle became embarrassed at his obvious shoddy work. He learned an enduring lesson, quote, not just to tell the whole truth and nothing but the truth, he told author Robert Slater. More than that, the lesson was to skip the shortcuts. So now, to tell the whole truth and skip the shortcuts about Wall Street's future, I give you John C. Bogle.
Thank you, John. Thank you so much, John. That's a lovely introduction with a story that is unfortunately true. I couldn't help thinking as I came down in this rainstorm today that there must be some similarity between the weather and the stock market. And I thought the storm was bad outside until I got inside here and looked at the quotations. And I'm going to talk a little bit with some numbers to you today, and we will have a handout copy of the charts, some charts and some things that will go with this speech if any of you are interested after the talk. So don't be disturbed if you can't stay with the numbers. I like to rely on facts where I possibly can. And I begin the speech by saying, wow. Late last December, when I accepted your invitation to speak, I selected the title, After the Fall, What's Next for the stock market and the mutual fund industry, reflecting my expectation that the stock market would continue to fall, but I can tell you that I did not expect it to fall this far and this fast. When I picked that title, however, since I picked that title, stocks have moved into the worst bear market, a decline of at least 20% from the high since 1987, and the second longest bear market since the 21-month 50% drop from 1973, 1974. Since the highs last year, the aggregate value of U.S. equities has now tumbled by almost a cool $5 trillion, from $17 trillion a year ago to just a little bit over $12 trillion today. That's a market and a half. Driven by technology stocks, the NASDAQ index, as you know, has tumbled from 5,048 a year ago to, well, 1,850 or so yesterday, 63%. And obviously, the bubble in the new economy stocks has burst. The Standard & Poor's 500 index, much broader representation of the total market, is now off probably 27% from its high. Technology stocks, to give you an example of what's driving this market, were 34% of the S&P 500 a year ago. They're 18%, just about half that amount today. How do you get these bubbles? Well, in this case, a once-in-a-generation combination of a booming economy and the optimism of a new millennium, the ebullience engendered by a quarter century without a single protracted market decline, a time of unity, mostly in the U.S., and peace, mostly around the globe, robust growth in corporate earnings, but not without some awfully aggressive earnings management, and the siren song of a new era. The information age, the new paradigm with growth projections for high-tech companies that lost all touch with reality. Those are the ingredients. And truth told, it was not very difficult to see it all coming. Indeed, right at the high of the market a year ago, I gave a speech entitled Risk Control in an Era of Greed, pointing out that when reward is at its pinnacle, risk is near at hand, and reminding my audience of a quote from the Roman orator Cato, 2,200 years earlier. Listen to this in view of today's market. There must certainly be a vast fund of stupidity in human nature, else men would not be caught as they are 1,000 times over by the same snare, and while they yet remember their past misfortunes, go on to court and encourage the causes to which they were owing, and which will, once again, produce them. End of Cato quote. Quote from Bogle, looking at the stock market a year ago. So let me be clear. March of 2000. You can place me firmly in the camp of those who are deeply concerned the stock market is all too likely to be riding for a painful fall, a fall that may well have begun as I began to write this speech 10 days ago. Viewed a decade hence, today's stock market may be just one more chapter in extraordinary popular delusions and the madness of crowds. Now, it was just dumb luck that my timing was so prescient. But like most investment professionals, I think, we have a pretty good idea of what is going to happen in the markets, even if we have little, if any, idea of when. Nobody knows that. Nonetheless, I'm going to take a look today at what we might expect from the stock market during the coming decade. To do so, I want to talk about some very important fundamentals that you'll just have to bear with me on, because you can't understand the markets if you can't understand what I'm saying. The mathematics of the market are eternal. Complex and mysterious as the stock market may seem, its returns are determined by the elementary interaction of just two simple elements, albeit two elements whose qualities are different as night from day. The first is investment return, determined by dividend yields and earnings growth. Investment return tends to be recurrent and steady. The second is speculative return, reflected simply in a change in the price-earnings multiple, price that an investor is willing to pay for $1 of earnings. Speculative return is intermittent and spasmodic. Add them together, we have the market return. It's that simple, it really is. And over time, it is earnings and dividends, investment return, that determine all of the return that is achieved by the stock market. Consider the past 40 years. Dividend yields plus earnings growth over that period came to a total of 11.2%. The actual return of the stock market was an identical 11.2% per year. In the long run, as it turns out, earnings and dividends call the market tune. But speculative return can be the driving force over short-term and even over extended periods. For example, in 1961-81, the first half of that 40-year period, the PE fell from 22 to 8 times, resulting in a speculative return of minus 4% per year, 4.5% a year, reducing the investment return of 12% then to a market return of 7.5, 12 minus 4.5. During the second half of the period, 1981 to yesterday, the period in which most Americans have gained their investment experience, the PE ratio soared to as high as 33 before retreating to the present level of 24, still enough to add 5 percentage points a year in speculative return, raising the annual investment return to a market return of 15%. Now think about what I've just told you. Despite the all-time market returns, high market returns we reveled in the past 20 years, the fundamentals of earnings and dividends were actually a bit lower than in the previous 20-year period, 10% versus 12. But the annual report market return more than doubled from 7 to 15. Why? Simply because the pendulum of market speculation, which pulled returns down as it swung from the grand ebullience of 1961 to the pessimism of 81, sent returns soaring as it swung back to the roaring optimism that culminated just as we celebrated the new millennium, a year early, I should note. And what a difference it made. Consider the magic of compounding on an investment return over each of those two 20-year periods. The 1961 investor earned 7.5% and enjoyed $32,000 profit at the end of the period. The 1981 investor earned 15%, a $140,000 profit by March 2001. That remarkable increase from $32,000 to $140,000 came not from higher corporate profits or dividends, not at all. Actually, they were lower, but solely because of a change in investor attitudes. The point is that the economics of market return, the earnings and dividends of American corporations over 2 centuries have always been both predictable, almost always, and productive. The emotions of market return, on the other hand, the price that investors will be willing to pay for each dollar of earnings, are unpredictable, sometimes productive, sometimes remarkably counterproductive. I use this dramatic example of the two forces that determine stock returns. I call it the oasis of investment versus the mirage of speculation, mirage that's fading as we speak today, to look ahead and consider what we might find in the coming decade. We begin with a yield, dividend yield of only 1%, a fraction of the historical norm of 4%. To put it bluntly, that is not a lot of gas in the stock market's tank. But if we assume that corporate earnings growth will continue at 7% annual rate, historic, stocks would enjoy an investment return of 8% annually during the coming decade. Will speculative return enhance or reduce that figure? That's the question before the House. If investors continue to pay 24 times earnings, as they do today, that market return will be the self-same 8% per year. That's what the market holds for us. If the PE goes to 18 times, drops, that would result in a negative speculation return, speculative, of minus 3%, bringing that 8% down to just 5%. If, on the other hand, the PE were to rise to 30, we'd have a positive speculative return of 2%, bringing the market's return to 10%. I think the current PE of 24 cannot be sustained. I think it's more likely to go down than go up, and therefore I believe that 5% is a much better guess than 10% as the future market return. Warren Buffett, by the way, used a very similar, different I should say, but equally disciplined methodology, and he comes up with an estimated return in that range, 5–6%. You'll have to decide how much comfort you want to take from the fact that Bogle and Buffett agree. I wouldn't take too much from it. Maybe we'll be wrong on the low side. What, you might ask, would it take to produce another 15% return in the coming decade? It's easy. Assuming the investment return is 8%, it would require a speculative return, if you're sitting down, of 7%. That is, it would require a final PE ratio of 47 times earnings. To be clear, I don't think that number is remotely in the cards. In short, we have now departed a 2-decade-long golden era for equity investors in which we literally never had it so good and are entering an era in which the party is over. Alas, I do not believe we have yet seen the stock market's lows. Maybe today, though, for while we're approaching prices that represent close to fair value, I think, don't ever forget the market overdoes everything. That pendulum, remember, swung so far above fair value that when it comes back down, it's not going to stop there, but it's apt to get to a very cheap level and overswing on the downside as well. A new environment for investing, which is more likely to be bland than spicy, would not be without precedent. For example, the Dow Jones average was 1,000 in 1966. It touched that another half a dozen times in the next 17 years and was still 1,000 in 1982 before permanently moving upward. Despite the promise of Jim Glassman's Dow 36,000, I think it's at least possible we'll find the market in a trading range, say plus or minus 25% from where we are today, of 10,000. Not for 17 years probably, but for an extended period of time. It's possible. But whatever returns the market may deliver, don't make the mistake of thinking that investors will actually earn those returns. The fact is that few investors ever capture 100% of the market's long-run annual rate of return. Why? Simply because investing costs money. The fact is that a huge proportion of investment success is represented by the allocation of financial market returns between investors on the one hand and financial intermediaries and tax collectors on the other. For investors as a group, market returns minus intermediation costs and taxes equals investor return. It is as simple as that. Costs matter. They matter most where they are 1, very large, 2, easily measurable relative to the value of services provided, and 3, compounded over time, as you've seen. And those are 3 of the defining characteristics of the mutual fund industry. Fund costs are numerous and substantial. I might even say never-ending. Let me add them up. Management fees and operating expenses now average 1.6% a year. Sales charges, at least 0.5% annualized. Hidden portfolio transaction costs, you don't see these. With funds now turning over their portfolios at 100% a year, an absurd rate, 0.7%. 1.6, 0.5, 7, that's 6, 2.8% a year. And another opportunity cost of 0.3% a year because funds are rarely fully invested in stocks. 0.3%, aggregate cost 3.1% per year. That may not seem like much, but it would consume 31% of a 10% market return. Throw in the extra taxes investors are socked with as a result of all that hyperactive portfolio trading activity, I'll come back to that in a moment, could easily take, in the current environment, another percentage point and a half, leaving just 1/2 of the market's annual return for the fund investor if the return is 10%. Simply put, there are too many croupiers in the mutual fund casino, and their rakes sweep too wide a swath from financial market returns. Fund investors have not yet focused on the confiscatory power of costs. Why? Because the stock market's return has been so generous. 15% in the last decade meant that the average mutual fund, it won't surprise you, earned 15% before cost, but after cost and taxes, in fact, delivered an estimated net return of about 9%. Result, $10,000 invested in the average fund, profit of $46,000. A lot of money, but less than 1/3 of the profit on the stock market itself, which without costs or taxes grew by $154,000 instead of $46,000. Despite this abysmal shortfall, however, fund investors, I think, felt pretty comfortable because they'd made a lot of dollars even though they had not received a fair share of the market's returns. What happens if the future market return is 5%? Assuming that fund costs don't decline, the tax costs do in a lower return environment, the average fund investor in a 5% market could receive a 1% return, with many stockholders garnering negative return. 5% in the market may not seem like much, but it'll give you $6,000 on a $10,000 investment in a decade. At 1%, it's a $1,000 profit for a decade of investment. I think disappointment would be far too mild a characterization of a shareholder's reaction. So in a future market environment of lower returns, the confiscatory power of excessive mutual fund costs and unnecessary taxes will severely challenge this industry. In many respects, this industry is a child of the great bull market of the past 2 decades. That's why equity funds have gone up 100-fold from $41 billion 20 years ago to $3.7 trillion today. But in a bland market environment, the fund industry would face very serious challenges and will have to get its act together. How? Significant reductions in management fees are long overdue, and if fund directors lack the willpower and knowledge to demand them, investors are going to finally vote with their feet and abandon funds that hold excessive costs, finally forcing down fund fees and operating costs. Transaction costs, another big cost, must also decline as the counterproductive short-term speculation that is the focus of so many fund portfolio managers today. The average fund now holds an average position for 11 months. That will have to abate. And once we return to the industry's once traditional, when I came into this business and when I wrote my Princeton thesis, long-term orientation, when the average holding period of stock was not 11 months but 6 years, that's long overdue and would reduce not only fund transaction costs but the heavy tax burden that funds that turnover foists on unsuspecting fund shareholders. It's not coincidental that this gradual shift from investment to speculation has come hand in hand with a shift of portfolio supervision in funds from investment committees to portfolio managers, and then the following development of a star system. Alas, however, I must tell you, the fund industry has produced infinitely fewer stars than it has comets. The devastating toll of this extraordinary level of portfolio turnover is not possible to underestimate. The direct turnover costs themselves, $28 billion last year, paid to brokers, market makers, investment bankers. But that's the least of it. Despite the fact that last year fund investors suffered $240 billion of capital losses last year, they received $345 billion of taxable capital gains distributions because the industry has this high turnover. And a third of those gains are realized on a short-term basis and taxed at ordinary income rates at that. Unrecoverable tax cost that shareholders have been suffering because of the industry's short-term investment strategies. It's not a good idea. Central to the fund's industry's problems, which John mentioned in the introduction, is the accumulation of assets under management has become the name of the game. The magnetic attraction of distribution in the fund business has become irresistible. And so it is that aggressive marketing has long since superseded prudent management as the central ethic of the mutual fund industry. We all know in the abstract here about marketing one thing: the best marketing, offering the public exactly what it wants. And if its ability to follow the crowd, the mutual fund industry has few peers. If the investing public demands cake, well, let them eat cake. The problem is the most desirable cake is inevitably the cake that has been the sweetest in the recent past. Never mind that the exceptional past returns some funds achieve are all too rarely prologue to exceptional future returns. Indeed, quite the reverse is true. St. Matthew had it right 2,000 years ago. Many that are first shall be last, and the last shall be first. You heard it here. Taken to its logical conclusion, such a marketing strategy inevitably places mutual fund managers in the wrong place at the wrong time. Consider the past decade. Began in 1990 with stocks in the bargain counter, yet the smallest component of the industry's 1.1 then trillion asset base was in equity funds, 25% of the total. Bonds and money market funds, 75%. Caution was the order of the day 10 years ago for the investors and for the industry. Now advance the calendar to the first quarter of 2000. The stock market had risen 500% in that period and was, at least in retrospect, very richly valued. But the equity fund share had more than doubled to 62% of the industry's huge $6.3 trillion base versus 38% at the beginning, 38% in money market and bond funds, down by half. When stocks were nearly at the cheapest levels in modern history, mutual funds had a 25% exposure to stock market risk. When stock prices reached the dearest levels ever recorded, taking into account the extra riskiness, which I'll comment on in a moment, of equity fund portfolios, a 75% risk exposure, 3 times as much risk exposure as the high as at the market low. For that counterproductive increase in risk, we can give much of the credit to the fund industry itself. To understand what a marketing industry had become, just consider the shift in equity fund capital flows during the years leading up to the stock market peak last March. During the 90s, net investor purchases of U.S. equity funds were almost exactly divided evenly between 50% in relatively conservative, middle-of-the-road, value-oriented stock funds and 50% in riskier, more aggressive, growth-oriented funds. But in 1999, the growth share leaped from 50% to 92%, and in the first quarter of 2000, the growth fund share leaped to 113% of capital flows. On the other side of the coin, the share of cash flow into value funds dropped to 8% in 1999 and to minus 37% during the first quarter of 2000. That is, in that first quarter, investors purchased $127 billion of the risky growth funds and liquidated $42 billion of the safer value funds. At the very moment they should have been minimizing risk, fund investors were maximizing their speculative risk. Clearly, relative performance was the reason. Growth and value funds provided very similar returns from 1990 to 97. And then growth funds soared into the lead through early 2000, providing annualized returns of 42% a year, far ahead of 8% per year for the value funds. But reversion to the mean, that seemingly universal rule that the last shall be first and the first shall be last, over and over again, promptly took over. And since last March, growth funds have declined 44% on average, while value fund prices have actually risen by 1%. It would be very easy for the industry to argue that the investor, ever following past performance, following the crowd, is his own worst enemy. But the industry must bear a large share of the blame. First, it pandered to the public taste by creating 494 new growth funds during the last 2.25 year period, compared to just 110 value funds. Second, not only did funds vastly step up their advertising budgets to jump on the stock market, to encourage investors to jump on the market bandwagon, but advertised the heady past performance of some of the industry's hottest funds, with annual returns exceeding 100%. What's wrong with that? Well, at least these two things. First, winners rarely, if ever, repeat. And those who produce advertisements hyping past performance are every bit as aware of that inevitable fact as the countless academics whose studies attest to it. Second, advertising is expensive. Directly or indirectly, it is the mutual fund shareholder who foots the advertising bill. In the past 2 years, the industry's seemingly unbridled marketing budget likely included $1 billion for media advertising alone, not including, I hasten to add, $120 million that one fund sponsor recently spent to have a football stadium carry its name. Imagine that. To put it bluntly, fund shareholders had $1 billion of their money spent on advertising. How this expenditure advanced their interests or their returns is certainly not clear to me. This marketing opportunism found its finest, if most perverse, focus in the fund industry's response to the information revolution, or more accurately to the soaring returns generated by information technology stocks. Internet companies, cell phone makers, computer manufacturers, semiconductors, the works. During the early 1990s, some of the years, one new technology fund was created. Some years, no new technology funds were created. In 1999, 29 new technology funds created. In the first quarter of last year, 71 more technology funds. And investors took the bait. In the first quarter of 2000, technology funds alone garnered 30% of the industry's all-time record cash flow of $113 billion. Up to then, the returns on technology funds had averaged 92%, annualized, 92% per year, more than double the returns, even the soaring growth funds. But in the aftermath of the tech stock boom, tech stock funds have dropped by 67%, more than half again, the 44%, I think it was, tumble in the weak growth fund group. Sweet marketing, it turns out, is usually sour investing. The paradigm of the paradox, the time to sell funds is not the time to buy them, not the time to buy them, came last March when a giant brokerage firm sold its clients two New Era funds, an Internet Strategies Fund and a Focus 20 Fund, right at the market's high at an offering price of $10.55 per share. Après moi le déluge. At yesterday's close, the net asset value of the Internet Fund was $2.44 a share. It was. The Focus 20 Fund, $3.24. It was. By obliterating $1.4 billion of investor assets into thin air, this fund, viewed at the time as a marketing triumph, has become, at least for the moment, an investment disaster. And so the chickens have come home to roost. And I hope it is not ungracious here today to my host in the press if I point out that both the media's embrace of the new economy and its focus on short-term investment thinking and past performance has helped lead mutual funds investors astray. And now that the party's over, I hope everybody in the room involved in journalism will help to refocus the attention of serious investors on long-term investing, on reasonable expectations, on diversification and asset allocation, and cost and tax efficiency. Standing up for those eternal principles of investment success would be an invaluable public service. The equity fund deck of the huge mutual fund battleship, by the way, with its high expenses, excessive tax costs, short-term investment orientation, and marketing-driven focus, is not the only deck of the battleship in need of repair. The bond fund deck is another. One failing is the industry's near shunning of bond funds just when investors needed them most. Another is offering bond funds with such high costs that they deserve to be shunned. In a new environment in which bond returns are apt to be much more competitive with stock returns, all the while carrying much lower risk, the industry will have to rectify these failings. It's hard to overstate how much refurbishing that deck of the industry ship requires. Excessive management fees and operating expenses, excessive portfolio turnover costs, excessive sales charges wreak even greater hardships on bond investors than they do on stock investors. Consider the simple mathematics. Today, the yield in the Lehman Aggregate Bond Index is 6.6%. If an investor pays a 4.5% initial sale charge and a 1% expense ratio and holds the fund for 5 years, his average yield would be 4.6%. 2/3 of the return to the shareholder, 1/3 to the croupiers. And for a tax-exempt bond fund, the penalty is even greater. Clearly, that's a far cry from a fair shake. And yet nearly half of the 1,900 bond funds in this industry carry a sales charge. The average expense ratio is not 1.1%, it's not 1%, but 1.1%, and only 75 of 1,900 funds, 1 out of 25, have expense ratios below 0.3%, my idea of a fair shake. Yet when investors will turn to bond funds in the new environment that's emerging after the fall in the stock market, they'll have few choices that make even the most tenuous economic sense. So in bond funds, too, the industry has much more to do to learn the loyalty and trust of fund investors. Now, lest I paint the industry with too broad a brush, let me say there are some firms that have resisted the temptations that I've cataloged today. Some firms that have, 1, minimized costly and aggressive marketing, 2, shared at least some significant portion of the staggering economies of scale in this business with investors by holding the line or even reducing costs. 3, maintained investment discipline in portfolio management and focused in the long term. And 4, avoided the fads and fashions of the day, introducing new funds not just because they make dollars for the manager, but because they make sense for the shareholder. No firm, I repeat, no firm, has a discipline to bat 1,000 in this tough league, but there are at least a few that are batting upwards of 750, but painfully few. Out of the 400 complexes in this business today, I don't think I could name more than a dozen that meet my high, but I think reasonable standards. Let me wrap up with a confession, because I read somewhere that confession is good for the soul. I confess that I make my remarks today from a very singular vantage point. When I founded Vanguard 26 years ago, it was deliberately structured as a mutual fund organization, controlled not by an outside management corporation, but by the fund shareholders themselves. So cost obviously matters. I guess I've made that clear. We operate on an at-cost basis and do not squander shareholder resources on marketing. This focus on the shareholder quickly led me to the founding of the industry's first stock and bond market index funds, which do provide substantially 100% of the market's annual returns, and the elimination of all sales charges. It is putting the shareholder first in everything we do that has been the foundation of whatever success Vanguard may have enjoyed. So if the criticisms of the fund industry I've expressed today sound tough, it is not, I assure you, because of my pugnacity. It is because of my perspective. And while few firms will, and indeed realistically few firms can follow Vanguard's example, any firm that wants to be as successful in the new environment after the fall as it has been in the old environment before the fall will have little choice but to take some steps in our direction. It's high time this industry gets back to the business of prudent, long-term investing. It's best, unequivocally, to place stewardship, serving clients in the most honest, efficient, and economical way possible. That's a little quote from my senior thesis at Princeton. Put that at the top of the agenda. It's that single value, the stewardship of other people's money, that will place the mutual fund industry, and only that single value, that will place the mutual fund industry on the right side of history. Thank you very much.
As you might imagine, we have a few questions. And it is probably no great surprise to you that a lot of those in our audience would like a little investment advice. Where's the Dow now? Last month on Louis Rukeyser, you summed up your investment philosophy as buy everything and hold it forever. Do you still subscribe to that in light of what the market has been doing, or would you unload some things now?
No, my theory is not subject to the ups and downs, the peregrinations of the stock, the unpredictable peregrinations of the stock market. It's painful to do, but I think the idea of owning the stock market is the best approach to equity investing, and perhaps I didn't make that thoroughly clear there. I have never felt that equities should be the only portion of an investor's long-term program. I myself am about 50% stocks, 50% bonds, for example. I was brought up when I came into this business in 1951 with the Wellington Fund, which was and is, and I hope always will be, a conservative balanced fund. But I think the idea of buying and holding forever and not trying to make adjustments requires that you've gotten it right in the first place. That you can only hold tight if you've bought right, if you will. And that is to say, have an asset allocation that has something to do with how many years you have to accumulate money, how much resources you have at stake, how much income you need, and how much courage you have to ride out the peregrinations of the market. So you've got to take all that into account from that simple statement.
You are the godfather of index funds aimed at the average investor, and this questioner points out that actively managed funds have outperformed indexed over the last 2 years. Is there a case then for market timing? What should you do when the index funds are losing money?
Well, as my friend Jim Glassman quoted me in his op-ed piece in the Wall Street Journal yesterday, it's a quote I don't even remember where I made, but it said, I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market. Last year, these last 2 years, the index, S&P index, has outperformed roughly half of the funds, a little bit less last year, just about half this year. I don't regard that as a significant long-term sign at all. First of all, the number of funds is not a relevant statistic. We use it because it's convenient, but if you've got a few little funds in there that do well, they count just as much as a few big funds. The reality is, no matter what the statistics tell you, indexing always wins. I say that because index is delivering the market return, and all those investors out there are by definition getting the market return themselves, less cost. So if statistics don't capture that index advantage, it will be corrected in the next year or the next year. And by the way, if you look at even the last 15 years, counting those last 2 years, the index has outperformed about 75% of all active managers.
Someone out there will want to take careful notes here because we're going to go from the general to the very specific. For the past 15 months, I've been investing $1,200 per month in Schwab mutual funds. He or she doesn't say which Schwab funds. Should I continue, or is there a better place for that money these days?
Well, far be it for me to get into more trouble with Mr. Schwab than I'm in already. But leaving aside the infinite variety of a stock of mutual funds they could be buying through any kind of a mutual fund marketplace like Charles Schwab's, the answer is yes, continue to invest. I've told particularly young people in the office who are really petrified by this market decline that it's the best thing that ever happens to them. And if you think about it logically, of course it's wonderful. I mean, think of, say, the young man I was talking to yesterday who's probably 25 or 26 years old, and he's got the rest of his life in invest. And I said, well, let's suppose that Chris Scott, his name is, I said, let's suppose, Chris, that the market's going to end up at Jim Glassman's 36,000 by the time you retire. Do you want to be investing all your money when the Dow is at 35,000, or invest it all when it's 9,000? Just think about that for a minute. In other words, you want a long time to invest at low prices, and it's certainly a frightening advantage for those of us who have some money at work in the market today to think of this as a blessing. But it is a blessing because in the long run, investing depends on accumulating money at sound prices and not inflated prices like we have. I also think the general economy and the financial markets are well served by a return to reality. When you leave reality and depart from the laws of gravity, there's nothing but bad things that can happen, and the higher you fly, the more you fall. We flew quite high enough, and I think it's a blessing, maybe a blessing in heavy disguise, a blessing that we've come back a little bit toward the ground.
Speaking of coming back toward the ground, this investor's stocks are really down. Dr. Koop, just for feet. Is that Quigley Pharmaceuticals? Cisco, Lucent Technologies. Should I sell?
I haven't heard a list like that. He even makes those tech funds I told you about seem like heroes. I don't have any comment on those individual stocks. I mean, they are hugely depressed. I think Dr. Koop, I read the other day, is in danger, the stock is in danger of becoming delisted. I think it's sold up in the mid-30s, $30, and now is something like 19 cents. You know, it wasn't a good turn. And it's very painful for people, for speculators, or people that greed overwhelm their good judgment to get hurt. But will they bounce back? I mean, I guess the answer to that group of stocks, without knowing much about Quigley's Pharmaceutical and being very nervous about Dr. Koop, is, companies like Lucent will come back in time. I don't think there's much question about that. But to own a handful of individual stocks, I don't think is sound investing. And to obviously jump on the bandwagon at a silly time is, I feel very, very sorry for the investor, but I don't know how to help him now, him or her.
You mean it's like if I had bought a NASDAQ indexed fund 13 months ago? What will happen to tech funds? Will they come back? We have similar questions for growth funds, value funds. Are those three sectors going to rebound?
Are the three sectors, growth, value, and tech funds, going to rebound? And I guess the answer is unequivocally yes. The more interesting question is when and how far. And it's very difficult to answer when, because I think we're in for some tough weather here for a while. I think the steam, the confidence has gone out of the market, and I think speculative enthusiasm has, and well, it held the market up. It can't hold it up forever. I've said to many groups that in this kind of an environment, if I was a betting man, I would bet on value over tech or growth, other kinds of growth. But I quickly reassure them and you that I am not a betting man. I just don't know how to do that. So I think if you're in heavily in technology, you should be gradually moving to increase the value orientation. If you're heavily in value, I'd be gradually, believe it or not, moving toward a growth orientation. I think technology is too small a part of the, too narrow a part of the overall investment economy to be considered a separate group. So I would try to diversify. If you like growth, I'd rather be in growth generally than just in technology. I will also tell you this, without any fear that I'll be wrong at all, and that is of these 71 technology funds that were created in the first quarter of last year, if half of them are still in business 5 years ago, I'll buy any number of people here up to 10 a good Cuban cigar or something.
You've made it very clear that you are neither a stock picker nor an industry picker. Nonetheless, what industries do you think might offer the most attractive potential in the next 5 to 10 years?
Well, the way to answer that, I mean, I can't answer that because I just don't know the answer to that. What you have to understand about the market is it comes just from what I emphasized at the beginning, from investment return and speculative return. And the market is, in the long run, a very brilliant arbitraging medium which takes into account the future prospects and prices them accordingly. So if I were to tell you this industry, let's say healthcare, for example, or probably technology will have a higher growth rate, I'd feel very comfortable about that. But do the prices take into account a lower growth rate and therefore will be very good for you? Or are they assuming a much higher growth rate than technology can possibly achieve and being bad? So I'd say I'm going to stick with my, my mantra here, and that is avoid individual stocks and avoid narrow stock groups.
You see anywhere other than the U.S. equity markets that is more attractive abroad?
The question now is about non-U.S. markets outside of the U.S. We call them international markets in the industry lore. More like foreign markets would be better. And I have to confess that I've had a bias against foreign markets for as far back as I can remember, simply because they carry risks that are not necessary to carry. They carry currency risk. Many of the particularly emerging markets carry extreme political risk, extreme financial risk. There are very few nations in the world that have the kind of protections for shareholders, the legal rights, the ownership rights that we have here in the United States. So I have a big bias toward the U.S., and I believe this will continue to be the most productive, entrepreneurial, innovative economy and more rapidly growing economy than any in the world. And I also point out quickly that when you get out, you don't need to leave U.S. stocks to have money outside the U.S., and specifically that roughly 25% of the revenues and 25% of the earnings of U.S. corporations come from abroad. So I don't think you need international funds for that reason. And I should say there's been this sort of canard that international funds would give you some much-needed diversification, which is a wonderful theory. But if you look back at the last year with the U.S. stock market down about 28%, the international market is also down, of all things, 28%. International diversification as a safety measure then let us down just when we needed it most. So I do not think you need to depart the U.S.
One thing that has changed dramatically during your watch on Wall Street is who are investors. 401ks have brought the vast body of Americans as individuals into the market. Has the spread of 401ks affected market psychology? Are these small investors more likely to bail during a crisis? And what effect has it had on the industry?
Okay, the effect of small investors, or having the public being the important part, the investing public, one might say the great unwashed participating in the stock market, has it in some sense made it more speculative. And that reminds me actually of a chapter I have in my original senior thesis all those years ago, where I had some quotes from Lord Keynes saying that as an institutional investing took over the financial markets, there would be more emphasis on investment and less on speculation. And that's what should have happened. But it didn't happen. When you're turning over your portfolios like mutual fund managers and other money managers at 100% a year, that's speculation, that's short-term speculation, that is not long-term investing. So the public, in spite of the fact they aren't as knowledgeable, they aren't as expert, they aren't as professional, is just as unwise as the professionals. Hopefully, and it's many members of the public, of course, are much wiser. I guess I'd say index fund investors, for example, although institutions use index funds very widely, actually more than the public uses them as well. So I think the biggest risk is that investors who are not accustomed to being responsible for their own retirement plans, 401k investors, for example, usually expecting the company to take care of that, are going to panic in a market like this and get out. I think that's the biggest risk we face, because in the 401k area, you can get out of your stocks without cost, without tax cost, without sales charges. It's very liquid and very quick, and liquidity in the market, it's fine to have a liquid market, but if everybody wants their money out of the stock market today, believe me, nobody is going to get it. So by increasing liquidity in that way, I'm a little nervous about it, but I think it will be all right.
And that leads to a policy question. President Bush's proposal to allow withdrawals to direct investment for part of their Social Security funding, to set up personal investments accounts under the Social Security umbrella. What do you think of that?
I'm always told I have very little difficulty making my position clear. I think it is a very bad idea. And I think it's a bad idea. I don't just make these things up out of the top of my head. I think it's a bad idea for two reasons. One is economic. And by allowing people to take 2 percentage points out of that 12.5%, 13% contribution, you will in fact, there's no argument about it, this is not fuzzy math, you will in fact reduce contributions to the Social Security program by $1 trillion over the next 10 years. That's a mathematical fact, and no doubt about it. I think the Social Security system, and I think everybody's ever thought about it, thinks the Social Security system needs either more funding or lower payouts. That's the only way it's going to work in the long run. So by taking lower funding, the payouts would have to go down even more. I think there have to be better solutions than the Social Security plan. I furthermore think the plan as proposed is economically irresponsible. And I think that for this simple reason, that the retirement savings of American investors are too important to be left to the wiles of the mutual fund industry. And I say that for this reason, simple economics. Having a lot of small investors buy mutual funds in their own Social Security personal investment accounts is going to cost more than that 3% number that I gave you, because handling all those little checks is going to cost $1 here and 50 cents there and little prices for this and that. So it might cost maybe 4%. So if the stock market gives an 8% return, the investor will get a 4% return when the money in the government bonds and the Social Security fund is earning him 6%. He's be taking a risk and getting a lower return, and that doesn't make any sense to me, and those economics, I think, are beyond challenge.
In the same neighborhood, compare and contrast, please, the proposed Bush tax cut with the Bogle administration's tax policy.
Well, unaccustomed as I am to public speaking or something, but without a speechwriter either, let me say, I think the Bush program, and particularly in light of the economic circumstances and market circumstances that have developed, and we're fundamentally, I think, in the economy, running into a risk that confidence will be severely damaged, I think is far too slow. It has the Bush tax plan would do nothing for investors this year. So I fault it on timing. I also fault it even going down the road on focus. I believe that the main portion of benefits, both economically speaking and socially speaking, should go to those with lower incomes. I believe it is targeted too heavily to the wealthy, and I don't think that's the appropriate way to target it. But not just because I'm half communist, if you want to argue that, but because I think the people who are much more likely to spend it are the people that need it the most. So I think economically some form of maybe tax rebate or something like that would be a better way to go at this particular stage. I also might as well get in even more trouble by saying I completely and unalterably am opposed to the elimination of the inheritance tax. I think that's absurd. It's not America to me. And even as I admit that, not admit, but encourage some inheritance tax relief, larger larger exemptions, not just for family farms and small businesses, but for all Americans, because I think all Americans, not just those two groups, deserve some inheritance tax relief, but not all the way up to $1 trillion. That's a bit of a push.
Thank you very much. We're going to ask one more question, but not before we give you a token of our appreciation for your joining us at the National Press Club, this certificate. And, of course, the coveted National Press Club mug.
Well, that's beautiful. Thank you so much, John.
Yes, thank you.
Great to be with you.
You faulted the President's, don't go too far away, please. You faulted the President's proposed tax cut as on grounds of targeting and timing. People have faulted the Fed's intervention in the market, in the financial markets, in monetary policy, as on grounds of timing and degree. Too little, too late, some have said. How do you assess it a day after this 0.5% that many expected to be 3/4? Please.
Always glad to get back to the mic. I think we have given much too credence to the possibility that the Fed is some, and Alan Greenspan is some, giant Buddha out there that can preserve us from our earlier mistakes and protect us from our future errors. And I just don't believe that. I think monetary policy has an important role to play in our economy, and honestly, very little role to play in our markets. The people that react to a 0.5 point or a 3/4 of a point, if we get that someday, change in the discount rate, are the traders who are not, the trader has no conviction about whether it's good or bad. The trader's conviction is that other investors will think that it's good or bad. It's just a big speculative market game. So I think Alan Greenspan has done just about the right things most of the way. I think he feels a lot of pressure. I imagine he's not amused about what the market did yesterday. But when we get a federal agency that's designed to hold up a market, I think we've taken our economic system far further than it can be taken.
And again, thank you very much, John C. Bogle. I would like to thank all of you for coming today. I'd also like to thank National Press Club staff members Melinda Cook, Pat Nelson, Joanne Booz, Melanie Abdow-Dermott, and Howard Rothman for organizing today's lunch. Also, thanks to the NPC Library for their research. Have a good day. Invest well.
Nice to be with you. Good luck.